Hello, this is Ross Young from DSCC, and I will kick off the Market Analyst Outlook session with a talk entitled 2020, a year like no other. I don't think I'm going to get a lot of disagreements about that. My initial topic would be 2020, who would have thought? Then I will talk about lessons from previous downturns, COVID-19 in the 20 to 25 display market outlook, and then I will ask and answer key questions. So 2020, who would have thought that the three fastest growing segments on an area basis would be tablets, notebooks, and monitors, three segments that have been in decline. That work from home and learn from home would become important acronyms, and with work from home no longer just reserved for your boss, that we'd be talking about double-digit growth in display revenues in 2021 with a brighter outlook post-COVID than pre-COVID. That the US president would be advising US citizens to inject bleach and UV light into their bodies to fight the COVID-19 virus. That speakers would be able to present to the SID business conference in their underwear. That I'd learn how to cut my own hair, and I'm not doing a very good job. And that there could be too much time with your kids, especially if they're musicians playing loud music all the time. Of course, I'm joking about that, but schools certainly do have their place. There have been many funny memes about 2020 about the coronavirus. Historians could introduce 2020 by saying what you're about to watch is a nightmare, very bad, would not recommend. Skipping school is now just a matter of hitting mute. And this last one asks, what is next, meteors or UFOs? And we've had evidence of both this year. Perhaps this one is the most appropriate for the US. We no longer care about how we look or drive our cars or buy cars. Alcohol consumption has surged, no comment. The internet has become even more important, and we've had a hard time coming to grips with masks. Initially, we didn't think they were important. Now we realize how important they are. I created this one. I thought it was pretty funny. Due to the uncertainty of 2020, which used to mean clear vision, analysts are ripping up their forecasts like Nancy Pelosi ripping up President Trump's State of the Union speech. I loved that moment earlier this year. Lessons from previous downturns. So in the 2000-2001 crisis, only one quarter went negative. Unemployment averaged 5.5%. Stocks fell around 48% over 2 years. We had a U-shaped recovery, but it took 4 years to fully recover. The cause was the collapse of the dot-com bubble, 9/11 attacks, and accounting scandals. 2001, in terms of the display market, was around 20% below expectations from 2000. 2002 was also below expectations, but by 2003, displays had exceeded the outlook. So what happened in 2001? Utilization fell. We had sharp price reductions. The price declines enabled the LCD monitor market to become more competitive, and it grew beyond expectations, leading to eventual better than expected results in 2003. So basically, LCDs took share from CRTs, and it was really the birth of the LCD monitor market, with 17-inch monitors falling below $999. If we look at the financial performance, we had very bad performance in 2001, with some companies seeing over or worse than negative 50% pre-tax profit margins. We see that the weaker players suffered more, and this leads to consolidation. We had Acer Display and Unipac merging, Chime acquiring ID Tech, and BOE acquiring Hyundai Display, which helped them on their way to becoming who they are today. If we look at the 2008-2009 recession, it was a deeper recession with 3 quarters of negative growth. It was caused by the subprime mortgage crisis, banks failing, hedge funds failing, Lehman Brothers going bankrupt, the stock market crashed, stocks fell 55% over 15 months, unemployment reached 10%. And the way that we got out of this mess was through government stimulus efforts. Fiscal and monetary policies really helped turn around the economy, and it took 4 years to reach new highs, but the stock market kept growing until 2020. In terms of the display market, you're looking at 2007 forecast, 2008 results were flat, below expectations. 2009 fell 10% and was 20% below expectations from the previous year. But by 2010, the market had caught up to previous expectations on 30% growth in 2010. So like 2001 period, there was a sharp drop in demand which caused prices to fall rapidly. The price declines enabled the LCD TV market to become more competitive, and it grew beyond previous expectations. Its demand grew so fast, it eventually created a shortage, and prices rose for a year. And so we had LCD TVs with LEDs really taking off. So by 2010, we had just about caught up to where we were when we made our forecast in 2007. And again, the panel supplier's financial performance was very weak. You could see very terrible results with negative 100% pre-tax profit margins. And this led to more consolidation, with Innolux acquiring Chimay and Top Poly, and Tianma acquiring NEC's fab in Japan and SVA's fab in China. So the summary of the lessons learned is that previous downturns brought prices down for future high volume products, such as 17-inch LCD monitors and 40-inch LCD TVs, which enabled them to cross the chasm from early adopters to early majority. We also had significant financial losses leading to consolidation. So let's move on to COVID-19 and the 2020 display market. So in COVID-19, we've had cases continuing to rise as it spread through the developing world and lingered in the US. Case growth has slowed since the end of March, but it's plateaued at around 12–13% a week for the last couple of months. Fatality growth has risen the last 2 weeks as case growth has risen. You can see number of cases per day are continuing to rise, approaching 300,000, and that the number of deaths is starting to rebound, unfortunately, due to the growth in cases. In the US, it's sort of a similar story in that we've had case growth start to accelerate. It rose for 6 straight weeks on a week-over-week basis after slowing to 9% at the end of May. Now we grew to mid-teens, and fatality growth has also accelerated for the past 2 weeks. And if we look at this chart, you can see the top 15 countries on a week-over-week basis, as well as selected other countries. US has more cases than the next 2 countries combined, and more fatalities than any 2 countries combined. The recovery rate is still very low in the US, with only 48% of total cases recovered. This is lower than even in the developing world, where case growth is much higher. You can see Brazil and India has much higher case growth, but they've recovered. They have a higher percentage of cases that have recovered according to the data. So that's certainly a major concern. The fatality rate is 4% worldwide, 3% in the US, but it has been double digits in much of Europe, although they have finally flattened the curve and their case growth is less than 1% now. Europe also has the highest death rate per 1 million people and the highest testing rates in many cases. Let's see here. Oops. So moving on to the impact on US jobs, we can see how it's ravaged the US economy, with a loss of 20 million jobs in April, and 7.5 million new jobs were created in May and June. Unemployment has reached, on a monthly basis, 15% and is improved, but it's still over 10%. Retail sales were impacted dramatically in April and have improved the last couple of months. US GDP was down 5% in Q1, and Wall Street Journal economists are expecting a 32% decline in Q2, followed by a 15% rebound in Q3 and 7% increase in Q4. China's results are interesting to look at. They had a large decline in retail sales in January, but have not dramatically improved since, only up 1% month over month. China's GDP was down 7% year over year in Q1 and up 3% in Q2, but retail and exports remain weak. The IMF put together a study in June on what the outlook was for 2020 and 21. They showed a 5% decline in 2020 for the global economy, 5% rebound in 21, but that was when the virus was expected to really weaken in Q3, and we have not seen that. It's in fact gotten worse, and so we've had reopenings paused and reclosings. The forecast did show China as the only country to show year-over-year growth in 2020 2020 and 8% growth in 2021, the fastest growth of any country. The US stock market is shown here. Stocks fell 34% from their February peak and have risen 47% since, but are still below previous highs. Tech stocks are, they fell 25% and have risen 46% and are well above their previous highs. So why have US stocks performed so well? Well, we've had faster action by the government with stronger strong monetary and fiscal stimulus efforts from the Fed and Congress. We've had the PPP program to enable companies to keep their employees. And we have a new catalyst. So we have something that's creating growth in work from home and the cloud. If you look at cloud stocks relative to the US large cap index, they've dramatically outperformed the US large cap index, and that's allowed for tech stocks and the overall stock market to recover faster than in previous downturns. You could see the results at Amazon, Microsoft, ServiceNow, Google, et cetera. They've been tremendous. And if you add Zoom, they've dramatically outperformed even those companies, up 179% over the last year. In terms of the timing of COVID-19 in the display industry, COVID-19 has occurred at a time when we had an oversupply in both large area and small medium. Capex is starting to slow after record spending from 2016 to 2018, fueled by Chinese government subsidies. We've had LCD supply shutting down, reducing the surplus, leading to faster price increases this year and beyond. We've had output constrained in Q1 on supply chain disruptions, and Q2 demand was expected to be soft due to retail shutdowns. Panel suppliers have not made money for 9 straight quarters, and we've had record low prices below cash costs. So they can't get much lower, unlike in previous downturns, and they were starting to rise. And the notebook, monitor, and tablet markets were declining. So they fell 5% in 18, 9% in 19, and we expected them to fall 2% in 2020 prior to COVID-19. So the display market was not in good shape. We've had, as you can see here, panel supplier revenues have been down year over year for the past 3 quarters, and 5 out of the past 6, and 7 out of the past 9 for publicly traded panel suppliers. Q1 is likely the bottom. We can see that BOE is approaching LG, and with LG shutting down, shutting down their LCD TV production in Korea. That's probably going to happen in the near future with BOE overtaking LG, even though LG is turning on a large OLED fab in China, but BOE is turning on a lot of new capacity as well. You can see Samsung still has the highest revenues disclosed on a quarterly basis. It got close to 25% of the market, and they too are shutting down a lot of LCD TV production in Korea. We have weakening panel supplier margins across the board. Gross margins are in the mid-single digits. Operating margins have been negative 3 of the last 5 quarters. And we think Q1 or Q2 is likely the bottom for operating margins. And we believe Samsung will likely show an increase. Let me do that one over. Looking at panel supplier margins, we've had 5 straight quarters with single-digit gross margins and negative operating margins for 3 of the last 5 quarters. The market we view is ripe for consolidation. Looking at operating margins, Q1 or Q2 may be the bottom. We think Q2 will get a benefit from Apple's payment to Samsung. LG's margins were worse in Q2, but it looks like than Q1, but it looks like Samsung's margins are better in Q2 versus Q1. If you look at Samsung's business, they've been at negative double-digit levels in LCD operating margins since Q1. They really have no choice but to exit, given the impact on its overall business. OLEDs have been relatively healthy due to its strong technical leadership and high capacity, despite the fact that utilization has been very seasonal and very weak in the first half of the year. Looking at capacities, after strong capacity growth in 2019, we actually see LCD capacity falling in 2021 due to Korea fab closures and conversions at LG and Samsung. You could see we show LG and Samsung with high double-digit declines in LCD capacity in 2020 and 2021, which will bring 21 capacity down 3% below 2020 and below 2019 levels. And we see here that the Korean suppliers are rapidly transitioning to OLEDs, with the majority of Samsung's capacity being OLED from 2021 and LG approaching 50% by 2025. In China, only Tianma is expected to rapidly convert to OLEDs because they're not in large area LCD today. Okay, so now let's talk about LCD capacity and the puzzle that is LCD consolidation. We see that there's been numerous reports that CEC Panda's non-choke lines are on the block due to its financial situation. They consist of 2 fabs in Nanjing at Gen 6 and Gen 8.5 and a fab in Chengdu at Gen 8.6. The Chengdu line has both amorphous and oxide capacity, which makes it attractive to someone pursuing OLED TV. China Star is expected to be pursuing OLED TV at a faster schedule, in an earlier schedule than BOE, which makes them a natural suitor. Also, they want to narrow the gap that it currently exists in capacity, with China Star at 11% and BOE at 20%. Also, they use VA, viewing angle capacity, as does China Star. That will leave Chote as its own entity with 3% share. Perhaps that could be acquired at some point. And we know that SDC wants to shut down its Suzhou line in the near future. It needs to stay in operation until 2022 as a result of subsidies from the local government, but it could eventually be sold as well, and it has around 2.5% share. So looking at LCD capacity today, without M&A, there's a pretty big gap between BOE and China Star, and you can see that LG is rapidly declining, as is Samsung. And if we look at what happens if China Star acquires most of CEC, the gap narrows significantly, and if the Samsung fab in China is also sold to China Star, it can narrow even further. So we could end up with a duopoly in LCDs, essentially, which may or may not be good for the market. So now let's move on to the impact of the pandemic on displays. And what we've learned is that we need our displays during a pandemic. COVID has created significant demand for displays, just like it has for internet and cloud services. So millions of students are without computing devices, which is creating new demand for tablets, notebooks, and monitors. Workers and contractors also need to replicate their office environments at home, which is leading to a lot of purchases of those devices as well. Cloud software providers like Zoom are even entering the display hardware market with extra cameras, microphones, touch, always on video conferencing mode to make at-home video conferencing easier and better. And we've also seen the TV market benefit with more time at home and less going out. Consumers in sub-regions are purchasing new and larger TVs, especially in the US, China, and Eastern Europe, as shown in May. Stimulus checks also led to TV purchases in the US and Japan. And you'll hear more about this in the TV session, but it's very exciting to see the TV market not being impacted negatively in some of the leading regions during this pandemic. And in fact, you could say that the longer the pandemic lasts, the better it is, certainly for IT markets, as more students and more workers may need to be working from home. Okay, so what are our pre and post-COVID forecasts? We're seeing much stronger growth than expected in notebooks, tablets, and monitors on work from home and learn from home. 8% growth in revenues versus a 2% decline. And we're showing phones much weaker than expected on weakness in retail, delayed product introductions. And if you're less mobile, do you need a new mobile phone? You're at home using Wi-Fi. Also, high unemployment certainly is contributing to less adoption of new phones. So while we had expected 1% growth in 2020 in units, we now see a 10% decline. And while we had expected 2% revenue growth, we see a 7% decline. However, we are seeing quite healthy growth in notebooks and monitors. and in tablets versus our prior forecast, with tablets up 27% versus our previous forecast in units and 25% in revenues. And relative to 2019, we see tablets up 10% in revenues, notebooks up 13% in revenues, and monitors up 3% in revenues. So it's important to identify that the slowest growing markets are now growing faster than ever, or faster than they have for a long time. And yet we're going to have these other markets like mobile phones and TVs snap back. And at the same time, we're seeing, because of the tighter supply situation, rising TV panel prices. We've seen strong orders in Q3, leading to healthy price increases this quarter. We think prices may fall in fourth quarter if demand doesn't rebound, and all the Q3 orders don't sell through. With supply shrinking, we think pricing will be flat in Q1, given the seasonality in Q1, but in Q2 and Q3, we expect to see healthy price increases next year from the Korean fab closures and also some delays in China on new fab ramps as a result of COVID-19. So we think prices could rise 3 to 9% in Q2 of next year and 2 to 5% in Q3. And if you look at Q4 of next year, all TV panel prices would be up year over year for the first time in a very long time. And at the same time, margins are going to be improving significantly as a result. So most LCD TV panels are above cash cost from Q2 21 in our forecast. So we're excluding depreciation. Today they're below cash cost. So we'll have high single-digit cash margins. This should boost the stock price outlook given the healthier margin situation. A lot of these fabs are already depreciated, so this could be a reflection of their actual margins. And we expect fab utilization to improve. So Q3 is up, Q4 is down, Q1 is up slightly despite the seasonality due to the reduction in capacity, and then much higher utilization from Q2 to Q4, with 90% utilization basically being very tight supply. And if we look at our long-term forecasts, we see the market actually bigger than we previously forecasted before COVID from 2022. So we see very healthy growth from 2020 to 2021, about 11%, and we see faster growth than previously forecasted in 2022, in 2023 and 2024. So the market will actually be 2% bigger than we had previously forecasted from 2022 to 2024 as a result of a better environment for the IT markets like notebooks, tablets, and monitors. We had production constraints from February to May. The loss of the Olympics, 8K, and the World Cup as catalysts hurt the market, as did losing much of the retail channel. We think Apple 5G, their phone launch may be delayed, or at least the availability of their phones, but we gain work from home and learn from home. We see TV catalysts returning. We think 5G will be more impactful next year with more 5G phone sales and a better network availability. We see supply shrinking in 21, prices rising, the outlook improving, 11% revenue growth in 21. And again, the display forecast is now higher than it was before COVID. Panel supplier stock prices are barely up year to date, up 1%, well below being up 20% plus in February, despite the improved outlook from work from home and learn from home. Only China Star TCL is up a lot, up 35%. We would expect to see higher stock prices given the higher demand, lower supply, higher prices, reduced capex, bigger market opportunity. So we think we could see some of the multiples expand, and certainly earnings expand for the display stocks, like we've seen in other stocks benefiting from work from home and learn from home. So in summary, COVID came when the display market was bottoming, supply growth was stalling, Korean suppliers were transitioning from LCD to OLEDs. So we boosted demand in the weakest markets, notebooks, monitors, and tablets. Even cloud software companies are entering with new hardware. We're not seeing price reductions like we've seen in previous downturns, but actually price increases. We're seeing a faster rebound than in previous downturns, despite the larger weakness to the global economy as a result of new demand. And the display supplier outlook is brighter, in our view, than it was pre-COVID, and stock prices should recover. So that concludes the main portion of my presentation. Now I'm going to have a little Q&A with myself. Okay, first question. What is your latest equipment spending forecast? Thanks for the question. My answer is that first let's talk about the methodology. The way that we are tracking spending is by leveraging a database that tracks purchase orders filed by Korean equipment companies, which reveals the total value of an order from which customer, and then an award database from China, which reveals the number of tools and the supplier of those tools for every type of equipment in each fab. So this could range from something very simple like computers or cleaning equipment to something very expensive like evaporation equipment. So we see hundreds of different types of equipment. What we've done is we've segmented the market into 79 segments, and we are tracking supplier share and the size of all of those segments. And in some cases, we have visibility out 2 years or even longer when a fab issues awards for multiple phases at the same time. But in terms of our forecast, this is it on a move-in and an install basis. The reason the numbers are different is that equipment can be moved in and then not installed. It's typically around 3 months from move-in to install, from the start of move-in to the start of install. But it could be years in some cases when they end up not installing the equipment for whatever reason. But in 2020, what we've seen is due to travel restrictions from Japan to China, where engineers are being quarantined in China and on their way back to Japan, they're just not going to China from like February to June. And so we're seeing a gap between when the equipment is moved in and when it is installed, because this equipment cannot be installed by local engineers. Other types of equipment can be installed by local engineers, which creates this significant disparity. But anyways, we've revised both numbers downward. But the 2020 delays are boosting 2021 by 5%. And we've also upgraded 22 on new fabs and delays from 21 and pull-ins from 2023. The average install spend is around 12 billion, which is down from previous levels, which should also help panel supplier cash flow. Next question, what is OLED versus LCD capex? You can see here that we're expecting LCD spending to end in 2023, OLEDs to lead 2019 to 2024 spending with a 69 to 31% advantage. What about by application, mobile versus TV? You can see it's very lumpy, but it's actually quite balanced. Mobile leads with a 51 to 49% share. What will OLED versus LCD revenues look like? With OLED in supply and surplus today, and capex much higher for OLEDs versus LCDs, OLED growth is going to outpace LCD growth, with OLED revenues rising at a 12% per year rate versus LCDs at -2%. So OLEDs will grow from 25% of the market in dollars to 39% by 2024. Where are OLEDs gaining share? You can see on a revenue basis that they're already a majority of the smartphone market due to their higher prices. They're also going to gain share in most segments, but will be limited to less than 25% revenue share unless availability improves and costs and prices fall faster than predicted. LCDs with mini LEDs represent a credible threat in many applications, although costs need to fall significantly for mini LEDs as well. When will OLEDs overtake LCDs and smartphones on a unit basis? We see that happening in 2023. We see rigid OLED prices already quoted as low or even lower than LCDs in some cases. We see 5G a catalyst for flexible OLEDs on space and power savings, and 5G demand rising and plentiful OLED supply leading to further price reductions. So we see that happening without a doubt in a few years. LCD volumes we see declining from 2022, with OLEDs approaching 1 billion units or 950 million in 2025. When will flexible overtake rigid? We show that happening this year with flexible OLEDs up 52% and rigid OLEDs down 22%. Rigid upside is limited. Prices are already as low in LCDs, and they have to share their capacity with a number of other applications as well, such as automotive and notebooks and tablets. So we show flexible volumes continuing to surge. Are LG and Chinese OLED suppliers gaining share this year? Yes, you can see tremendous growth here. We show BOE growing from 15 to over 35. We see China Star growing from a very small number to over 4. We show LG growing from around 12 to over 30. We show Visionox growing, so they're going to gain share. However, it pales in comparison to Samsung's numbers, which you see here. We do show Samsung's units declining, but their share is shrinking from 87 to 79% only. We see Chinese suppliers growing from 10 to 15% of the market, and LG growing from 2.5 to 6.5. Where is Samsung Display losing share? You can see that in this slide. We see Samsung losing share to LG at Apple, to BOE and LG at Huawei, to BOE and China Star at Motorola and Lenovo, to BOE at Oppo, and to China Star and BOE at Xiaomi. We show LG gaining share in Apple and Huawei and losing share at LG, Google, and other suppliers, or other brands. We show BOE gaining share at a lot of brands: Apple, Google, Huawei, LG, Motorola, Oppo, and Xiaomi. We see China Star gaining share at Motorola. We believe they'll start shipping to Samsung for the Galaxy M51 very soon. And we show China Star also winning business at Xiaomi and Google. What about the outlook for OLEDs and notebooks? We don't believe there's ever been as many choices for notebook brands and OEMs as they have now, as they can choose between amorphous silicon, oxide, LTPS, mini LED, rigid OLED plus TFE to make it even thinner, flexible OLED, which would be even thinner than rigid OLED plus TFE, then LTPO OLED, which will offer variable refresh and lower power, and finally foldable OLED. We see a lot of activity in OLED notebooks today, although there's just 1 or 2 suppliers at every size, and that'll have to improve. Mini LED will be a tough competitor here due to excellent contrast, wide availability from multiple panel suppliers, lower power than OLED, but it currently has very high costs, but we expect those to come down. So for OLED, they're going to have to improve availability and reduce power significantly, which will be helped by LTPO and variable refresh. We expect availability to improve. We think certainly a phosphorescent blue OLED material or a high efficiency blue OLED material can also help OLED power fall significantly. What big moves could happen in the next 12 to 24 months? First, BOE could secure a wide OLED TV panel license from LG. At the DIC show last week in China, they showed a 49-inch wide OLED monitor that they produced on their R&D line, which looks quite good. It's not clear that they actually need a license to produce wide OLED due to the old patents that exist, although some of those may have been continued, and it'll be interesting to see if a license is needed. It would be great for LG. It would establish a second source for wide OLED, create a high margin royalty stream most likely, and but a big question is, would the Korean government approve? Second second move that could happen is a high efficiency blue OLED material. Today, with high efficiency blue, you need the desired color, you need high efficiency, and you need the lifetime all achieved simultaneously. Typically today you see announcements achieving 2 of the 3. Or there are other ways around that. You can combine sky blue and deep blue, or sky blue and a color filter. Now that we're seeing OLED manufacturers pattern color filters in their OLEDs. Will it come from UDC or another material supplier, or maybe even a panel supplier that has gotten into the materials space? We'll have to wait and see. It would reduce OLED power consumption and likely boost penetration into notebook and tablet markets by reducing power consumption and narrowing the gap with other LCD applications like mini LEDs. It would also simplify the quantum dot OLED process by enabling them to shrink from 3 to 2 blue OLED layers. What about new UTG suppliers? We think that could boost the foldable market by enabling other brands to launch UTG-based products, but that may take longer than a year. That's still pretty uncertain at this point. We could see more consolidation in China. Some panel suppliers continue to struggle. And we could see new entrants in India. We've been hearing about this for years. I think it's potentially inevitable given the growth in demand in India for display devices. So that could be something that happens, especially if the government gets behind it with subsidies. Finally, what other innovations are coming? Well, you came to the right place. See the rest of the presentations at the business conference. I'll also talk about a number of innovations in my foldable talk. So thank you for registering for this event, listening to my long presentation. If you have any questions, I believe you can enter them into the chat area of the presentation. You could also email me at my email address or contact me on Twitter at DSCC Ross. Thank you once again, and enjoy the rest of the event.